we're getting close to 5 minutes. Try to come up because we can get better at this. You know what I mean?
Yeah,
Just
yeah,
over
yeah.
time.
What's up, guys? What's up? This is Random Rabbit. Welcome to the channel. We're officially starting our second podcast. We're here with Wyatt, Jack Rabbit. We're here with Jeremy Rabbit. And we're here with me, Josh, Master Rabbit, and we're just gonna dive right into it. We got topics today. The economy's been hitting, stocks been hitting, a lot of updates just from what happened last night. So let's jump right into it. Topic number one.
All right, yeah. So topic number one is big tech in the crosshairs from the Democrats. We have conversations from the DP as well. Big tech, it's kind of getting out of hand, and they have monopolies across industries in terms of vertical and horizontal integration, where horizontal integration is expanding to businesses that are outside your business, and then vertical integration is expanding in the supply chain, so owning all the pieces of the supply chain, including transportation, raw materials, stuff like that. But the Democrats were putting together a draft of a new bill, an antitrust bill that has a couple of points in it that are taking aim specifically at big tech to try to break up what they perceive as these monopolies. And a couple of other pieces of news with these is, besides that bill, right? Companies like Facebook, Google, big tech has been suffering from getting fined from other countries around the world for how they use data, how they use advertising, if they are creating monopolies on their own. So this has already been seen in a lot of other countries. Even in the United States, we haven't really been hitting them that hard from the political side. Other countries have been fining them, and Google, Facebook, for the way they use their data, for the way they use advertising data. And a lot of tech companies are also questioned when it comes to China. A lot of them are based offshore, right? They do manufacturing in China, and there's been talks that the Chinese government steals technology, or just at least borrows and learns from it. So, kind of with Joe Biden's policy for working against to compete against the quote unquote adversary of China, we want to make sure that that the technology is safe. So they're trying to reassess that and kind of have these companies answer for that and say, like, what are you doing to make sure that the technology and the intellectual property is staying safe to keep us competitive with China. But for the bill specifically, for the Democrats, the first draft is still in the works, right? It hasn't been passed, about 450-page thing after months and months of deliberation and research. But some of these policies include limiting the ability to own apps and marketplaces and also sell your own products through. And those are kind of direct shots at Amazon and Apple, right? And the whole walled garden idea, because the App Store, right, on Apple, so you own it, and then you can sell your own products through it. So you create this concept of kind of boxing people into a certain set of products and keeping them attached to those products, as opposed to allowing as much competition for them to leave and branch into other products. And some of the other things are, limiting the ability to complete large mergers, so just direct, kind of keeping monopolies down. Ending platform monopolies, so limits on how you can have a large platform that incentivizes its own products and services that creates a unique disadvantage to competitors. So, creating like same thing with Apple, right? Creating a system or a setup that makes it harder for other competitors to break into the market, right? Just anti-competitive. As well as there was this interesting one, the augmenting compatibility and competition by enabling service switching, the Access Act, which is trying to set standards for data portability and interoperability, making it easier for consumers to take their data with them to other platforms. So the idea there is protecting user data as owned by the user, not owned by a company, which is another big theme we see about how when you buy technology, do you own that technology, right? If you breach the warranty or try to do modifications to it, right? Technically, they say like it's our tech, you can't do that. So that's kind of a big topic as well in tech, is like, do you actually own your data? Do you own your technology? Can you really do whatever you want with it? So you can kind of see in these bills, we're seeing a lot of coming out to target these different parts of tech. So that's going to be something to watch as this gets kind of pushed through, and see how it develops when it have a first official draft come out into the world. So big tech in the crosshair.
Big tech, big tech. Any follow up to that, Jeremy?
Well, I know that Amazon uses a lot of your data, and who are usually the largest big tech guys that are looking at this bill and saying we don't want it?
Oh yeah, I would definitely say FANG stocks are going to be hit. Maybe not so much Netflix, but Amazon. They're moving into telehealth. They're trying to buy MGM, moving into space. I mean, Amazon's expanding in all directions. Apple specific, I think a lot of this is actually targeted at Apple, and you've seen a lot of that with the Epic Games fight about in-app purchases and how Apple wants to take 30% of that as well. So Apple's whole business model is really coming under fire. The way that they conduct products and the way that they kind of expand their product lines. So, but I think all this is just a kind of a shot across the bow to all big tech and kind of like a hey, we've really reserved monopolies for like traditional companies, but now technology is getting very big, and we're thinking about breaking it up or trying to break it up. And also just like Amazon, for instance, they not only own software and all these other cool industries, right, they expand to, but they own infrastructure for the internet, right? Their Amazon Web Services, how much of the internet actually runs and is hosted by their physical infrastructure? And does that give them an undue amount of power and control over the internet more than just informational flow? So we can definitely have a whole thing. I do want to have a whole segment talking about technology as a whole, because I personally believe we become too dependent on technology, even though I am a programmer. But yeah, those are the things coming across for big tech today that I think people should be aware of.
Sounds good. All right, let's jump into topic number 2.
Well, yeah, topic number 2, inflation is very much on the rise. The data shows that the prices for goods and services rose by 5% from a year ago at the same date. So in May, the inflation for this month relative to last year in May, we're up 5% higher than it was. So that's the largest increase in the CPI since August 2008, which was 5.4%. So there is inflation. I don't think anyone debates that there's inflation here. And the core price index, which excludes often volatile categories of food and energy, that jumped by 3.8% in May, which is the largest increase since June 1992. But again, no argument there's inflation here. I think the big argument is if the Fed's theory that this is transitory, that this is temporary, and that it's okay to let it run because we're making up for the shortfalls in employment, and this is going to help balance out the economy post the pandemic kind of society here. And the other camp is that, well, that might be true, but we need to start weaning ourselves off of this because we're going to start to see hyperinflation. We're going to start to see the prices go through the roof. I think Costco shows like 4.7% inflation in their products. So like we're seeing it. It's just the argument of whether or not this is something that's going to leave or if it's something that's persistent. And one of these things, like for instance, the Fed is buying $120 billion of treasuries and other assets in the markets per month, which is part of the quantitative easing. They also keep interest rates low, so borrowing is easy, and they're pumping capital into the market with the objective of really stimulating the economy. But if you just keep giving money and stimulating the economy, people will use that money to buy things that will artificially inflate prices. And if inflation gets too high, the value of the dollar begins to decrease, because that's how you look at inflation. You can look at an increase in the price of goods and services, or you can look at it as a weakening of the US dollar. So depending on your perspective there, because in both cases it's the same thing. Either goods become more expensive, so money buys less, or money is weaker, in which it can buy less goods. So it really depends on but both are basically true. And this is really they say it's a period of normalization. So high amounts of inflation is prices returning back to a normal state pre-COVID existence. But the question is, okay, well, how does normalization last, and when does that turn into something that might hurt us and turn into high inflation or turn into something that we won't be able to stop just by monetary policy? We don't want to pull the ripcord too hard and let the economy just run away with all this stuff until it pops up. So, but the numbers today, definitely inflation is there, inflation is on the rise, and the arguments are, is it transitory? Will it go away? Is it here to stay? And how long can we sustain it before it becomes a problem? And that's kind of the current debate right now. But inflation is definitely here. Things are more expensive.
So then, I mean, obviously there's a progression of inflation, whether it was before COVID, during COVID, due to scarcity of goods or high demand. What type of inflation are we currently looking at, and is this any effect from the COVID period?
No, it's 100% the effect from the COVID period, and that's why the Fed is not trying to change their monetary policy. They're like, prices are going up because people are spending more. There's a lot more demand. Everybody wants to go out and go on vacations. They even want to do things they didn't want to do before just because they couldn't do it for the last year.
Yeah.
So and people are more willing to pay these prices because they're more excited to go outside. And you see this in the stock markets as well. There's a lot of people have said there's a lot of stimulus money that people are just using to go and play in the stock market, right? To buy stocks. So people are using a lot of that stimulus money and are trying to push up prices, whether they intend to or not. And also you have the supply chain issues, right? Making things more expensive in general. And then you have issues overseas with Russia dropping off, like we said yesterday, Russia dropping off the $45 billion of its U.S. reserve currency and trying to move away from U.S. dollar denominated oil contracts. Symbolic at the moment, but if other countries get involved who own more of it, that could also hurt the dollar. So, inflation on a weak dollar needs to be kept in check, especially now that we're entering into this campaign of competition against China, where we have like this tech race now, as opposed to a space race with the Soviet Union. Now we have a tech race with China. So these things are going to become more important, and so inflation is definitely something that we should be watching every single day. We'll be talking about it as often as necessary.
Sounds good. Sounds good. Any follow up to that?
No. Jeremy's good. All right.
Sounds good. All right. That was 4 minutes 20 seconds. That looked good.
Good. We're getting better at this.
Yeah. All right. Let's go on to the next topic. Third topic.
Coinbase the cryptocurrency broker, teams up with a 401k provider called For Us All. It's a company that basically manages 401ks for about 400 clients that make up $1.7 billion of the $22 trillion 401k market as a whole, because there's business for everything. And what's happening is Coinbase is allowing those clients through For Us All to invest up to 5% of their portfolio in cryptocurrency. And For Us All is allowing 5%. Coinbase is just the broker. And this is interesting because we're seeing a push into more alternative investment strategies in retirement investing, which is interesting to try to get a little bit more alpha. Right? And that's kind of evidence that these riskier assets are starting to get on the mainstream. More people are saying, we want to get some of that alpha. We kind of want to get a piece of that, right? We don't want it just to be this asset that exists off into the distance. We want it to be something we can trade. And they won't let them go above 5%. One of the quotes here from I think it was the CEO, one of the guys at For Us All, says, they're not going to let my people YOLO Dogecoin to the moon. So there's a concerted effort here to make sure that this is done safely. So I don't think it's going to have any really material impact, but I think it's an interesting concept when we talk about risky assets and people putting money into it that they necessarily can't afford to lose. Right now it seems small. It's a very small part of the market, very, very tiny, like test case. But if that expands, right, and you get more people saying 5%, 10%, 15% of my 401k or my pension, right, more funds investing in these things, I think what you'll start to see is there will be more risk in that if it continues to proliferate and get bigger and bigger over time, because you just have more exposure to that risk. That's something to watch, because that kind of echoes like 2008 bubble or asset bubbles. Still very small. I don't think there's any fear of it now. And I think alternative investments are good for these portfolios to kind of size up and get in there. I just think we have to watch and be careful and make sure it doesn't get out of hand. But I still think it's interesting. It's definitely a big, a slower growing kind of industry now meeting a higher volatility asset class, right? So to see those changes, and we may see more of those changes. So I definitely think that's very interesting.
It definitely sounds like a type of like clickbait when it comes to, hey, you have your 401k. Hey, you've heard of all this crypto money coming into the market. Do you want to throw in 5% of what you are not really touching ever? It's already an investment. It sounds like an awesome way to grab their 5% and take other people's money and use it into the crypto market. So, I mean, I love this news because it only just shows the continued confidence in where crypto is going. And as a full advocate of crypto, we're going to ride this one to the moon, baby. All the way to the moon. We're just not stopping.
Oh boy. Well, yeah. So as I said, definitely something with trading, but it's definitely not. I don't endorse of it as a currency, but as an asset, sure. People want to capitalize on that. They see like crypto going from $30,000 to $60,000. They're like, hey, why can't I put some of my portfolio on that? You should let me do that.
Yeah.
So they're kind of branching out, and so yeah, I definitely think it's very interesting, and we'll see how this plays out. I mean, obviously, if you get a big percentage of your pension in there, then all of a sudden cryptocurrency drops. That might hurt, because usually pensions and 401ks are, the retirement fund where you're storing money for when you can't necessarily make as much money, right? Generate as much productivity to keep bringing capital in. So, but I think it's good they're starting out small and slow, and test out the waters. So definitely not going into the state that we have for other asset bubbles, trying our best, but we'll see how, if our desire for money gets the better of us as human beings. So,
well, that's
it's definitely going to be a riskier asset in the portfolio where everything's all mutual funds. They're actually going to put a crypto in there, 5%. I mean, shoot, if the crypto ends up overtaking that whole portfolio in gains, well, they will say that it was a good bet for them.
Well, and here's the thing: there's only like very few ETFs that have come out, so we're still waiting for mutual funds. We're still waiting for someone to make their own type of S&P 500 for Coinbase, or for not Coinbase, sorry, for cryptos.
I mean, we're
Right,
just waiting
like an
for
index.
those.
You
We're
know,
waiting for
there's no
those
index fund
large
yet. Like
companies.
there's nothing. Like we have nothing. And so
And
like
that's definitely a positive direction for people who want to get exposure in a safer way. And so yeah, I definitely think this is interesting news, and we'll have to keep monitoring this and seeing how this changes, not only for retirement style funds, but also with how more volatile assets are getting incorporated. And like Jeremy, if the gains of that from the portfolio gains of the alpha of everything else, there could be an opening for more percentages because people might get demanding and say 10% or 15% because we had 5% and we made this money. I want to be tripling the amount of money by having 15% of my portfolio in there. I think Jeremy's very right on that. If crypto keeps going up and these people make a lot of money, we could see this expanding.
And the closest thing that comes to an ETF on the New York Stock Exchange would be Coinbase as a stock.
Exactly, that'd be your best kind of exposure to the broker itself.
Mm-hmm.
So
Just need to wait on Goldman Sachs, JP Morgan in order to make an ETF or something.
need a big fund with money to back it up.
yeah, all right. Well,
Definitely.
that hit our 5 minutes. I really like that topic. I think that's gonna flow nicely into all our crypto channel.
Yeah,
And,
I like that.
all right.
Um,
Let's go on to
all
the
right,
fourth
so
topic.
our next topic is something I'm sure most people have heard about, regardless of how you get your news. The billionaire tax leaks show that the wealthiest investors, Jeff Bezos, Warren Buffett, the lot, it says, they're not paying their, as much in taxes. They pay only $14 billion in taxes while their wealth increased over the same period of $400 billion. And therefore the article that was released on ProPublica, I believe was, that was they said that the true tax rate comes out to about 3.4%. Now initially when you hear this and you see this, it's definitely clear that this would get people very emotional because we're at a climate now where we think we're upset. There's large gaps in wealth, and you're watching billionaires like Jeff Bezos blast off to space, while people are struggling to feed their families and pay their bills. So it's definitely stirring the pot, I think. But it's important to make a couple of notes here. When they're investigating who this was, should be investigating who leaked it. They should be getting in trouble because no one's tax return should be released. Think about if yours were released. You wouldn't like that. Just because someone's worth more money than you doesn't make them less of a human, doesn't make United States law any less applicable. So we have to keep it uniform if it's going to be law. And the other issue is with when you're paying taxes, the tax code, and this was a quote from one of the articles, it wasn't made for the workers, right? We pay our taxes on our income and our wages, and it's very straightforward. But when you get to these wealthier and wealthier investors, they pool their money into all these other assets that accumulate value and appreciate differently than income, such as owning stock positions. Well, you only get taxed on those when you take profit. So you can have positions that go to $1 million, $1 billion, $1 trillion, but if you don't take them out, they don't get taxed. Much like like physical assets, homes, other types of things that you can buy and store your wealth in that appreciate in value over time. So the taxes that are being paid by these individuals, as well as also tax advantages such as taking losses and then or selling losing positions or writing off assets at certain times to help buffet against a certain amount of tax, so you can effectively bring it to zero. I think the biggest thing this article does is it should show people ways that how billionaires and how these wealthy people do avoid paying taxes, and with the strategies they use that we can also kind of see and try to take advantage of them. But there is definitely an argument, and there's a whole different argument about how billionaires make money and how they have access to things that everyday people don't. But they do pay taxes on their income, and it does show them paying taxes on their incomes. Their income is taxed at the same rate, proportionally in the system that ours are. So they are paying the same rate of income, but it looks really bad because they're appreciating value, but aren't being taxed at the same rate. But you always have to remember, even if you took all the billionaires and all their families and took all their stuff, right, threw them away, you wouldn't even be able to generate enough money to replicate the stimulus that we did over COVID. And ask yourself, did all the money that you get, did that change your life? No. Well, if you took all the money from all these wealthy billionaires, you basically be getting a lesser form of that, and that's all that it would be. But that's not the solution for our problems. There are no easy solutions. As angry as it is, and I'm jealous and envious of rich people too. I want money. I got lots of money in college debt, and I don't live like a king, so I understand that human emotion, but it's not the answer. So we definitely take the benefit from it and learn from this article, but don't rally in the streets and call for Jeff Bezos's head, because he's also going to blast off to space, so you're never going to get him. He's going to live on Mars. Yeah, and I don't like Jeff Bezos and Kevin O'Leary and all these guys. I don't like them when they talk and the way they act and this smugness. But they're very smart people who have created big businesses. So that has to be respected. And there's this whole concept of the American ideology of being able to own and grow your wealth that it doesn't exist in any other country. So you got to remember those things. You can't just remove them, otherwise you start removing pillars of what makes America so great, and that damns us against the world. So definitely stirring the pot. Definitely a very interesting thing to read. Just make sure when you're reading it, you're not demanding their head on a stake. At least in this respect. That's mine.
Well, I feel like this is also the perspective that there's enough education out there to help you also do kind of the exact same thing that they're doing. Like, they're not breaking any laws, they're not breaking any rules. They're literally just using the rules to their advantage, all the tax laws, everything that they pay, millions and millions of people to get them out of, hundreds of millions of dollars. There's
a big argument here is with the things they can afford. So you can afford like lawyers and accountants and stuff that can help you do all this stuff. You can afford to pay to more money than the average person can to work with these assets, and then you just have assets to actually store and save. And then you also have the ability for billionaires to have more sway in politics and legislation and what they can afford to pay for, and they can pay for more lobbyists, and they can help pay for political campaigns. So there definitely is an imbalance in the amount of power that they have relative to the everyday citizen, the middle class, even though the middle class is what makes them rich in the first place. Well, regardless of whether they recognize it or not, it's thanks to the middle class. They are what they are. Without anyone buying and selling and working for them, they really wouldn't be a billionaire. But yeah, Josh is right. Within the tax code, they're not necessarily breaking any laws. It sucks, but are they doing anything specifically illegally? Not necessarily. They're just playing a very skeezy game that not a lot of us can play because we don't have the assets or the means to do it. But you should take refuge in this because there are ways to do it. When it comes to a stock market, right? How you can sell off some of your assets at certain times. That's a lesson to be learned. How you can put your money in other things. Even though we're not as rich as them, we can still follow some of these policies and some of these practices and try to replicate this in everyday life. So take it as a piece of education. Don't go outside their houses and demand their heads.
I'm sensing a lot of violence. Why I feel like these are back of the head thoughts of no, that's not allowed. But
I have to tell myself when I see this article, I'm like, all right, Jeff, this is how you want to go. All right, I hope your spaceship doesn't fall apart.
Is that the game you're trying to play?
That would really suck, bro.
Is that the game you're trying to play, huh, Jeff?
You don't want to pay taxes, bro? Well, maybe I don't want to tighten all the bolts on your rocket ship, bro. Oh my God, look how that works, huh?
Mr. Jeffrey, the giraffe. Okay, so we definitely blasted right through 5 minutes. That was a great topic. So we're
that's going to be in the news for a while. It's going to be in many news cycles. I get it.
Yeah, because everybody's talking about it, especially with I feel like Trump was one of the big ones where everybody's like, where's his tax forms? Like, why can't we see it? And then now that I don't think his ever got.
Well, he's subject of a criminal probe right now because they say he valued his assets at higher value. He valued his assets at lower value to avoid taxes, but then raised the price to get better deals and more funding from people. That we'll take that as it comes, right?
Yeah,
I'm no fan of Donald Trump or his presidency.
I'm sure there'll be news coming up on whatever the domino effect of that will be. Okay.
Right.
What, topic 4?
Topic 5.
Topic?
I think this is our topic 5.
Topic 5. Bring it on.
So the 5th topic today was the U.S. housing becoming more expensive, which obviously isn't something brand new to today. But what it is that we're seeing a lot more funds, right? Bigger investor entities buying houses for the purpose not of owning them, but of renting them, right? So they want to have a portfolio of homes that they can rent out and then collect the revenue stream, which could be seen as a way to bolster into your fund or into your account or just as a return to yourself. As we know from 2008. That's not good enough because just making that money is not putting that money to work, right? So how do you put money like that to work? You can securitize things. You can create an asset that you can sell on the market. And what does it derive its value from? The cash flows of the renters of all the properties you hold on your portfolio. So and they estimate about 1 in 5 homes bought by people aren't actually having people move into them. They're being bought to be owned for renters, and you're seeing a huge increase in the value of rental homes as opposed to homes that are being owned because people want the rental revenue. They more money that way. And let people come in and out. They don't have to have one homeowner owning this property forever. They can keep getting new clients, and then they can raise prices in between. They have a little bit of some flexibility there, or at least the potential for flexibility down the line. I imagine if this becomes a much bigger industry, you'll probably see lobbyists, if you don't already, pushing for the ability to have more flexible rates and be able to stay competitive in their pricing in terms of the rental rates. But one of the things here is a quote from one of the firms, the Wall Street Journal: limited housing supply, low rates, a global reach for yield, and what we're calling the institutionalization of real estate investors has set the stage for another speculative investor-driven home price bubble. So I think there's some truth in that, because home prices are already up high, both because no one's building as many anymore, because the things are being, materials are expensive in Jersey. Like the price of like a 2x4 is tripled. And then you have people that are just have high demand because they're moving out of the cities into the suburbs. They want to be safer from future pandemics. And if you're in a city, generally when there's illnesses and zombies and monsters and death, closed spaces with lots of people generally doesn't do so well for you. But there is a bit of truth in here, because if they're bidding up these prices as well, then you're seeing additional price pressure now. Houses going up in value because now investors are bidding for them. Investors want to buy them. So you're seeing an increase in the price of these homes artificially, just because there's more demand for them for a specific investment purpose. And then, like I said, if you have securitization, it's a bit safer in this way. I don't know if that's going to happen, right? This is me speculating as to what the next step could be in that cash flow. But I think it would be safer in this way because, people don't own them outright, so they can't default. The businesses own them, right? They have more control, more capital to back it. But you never know when you have securitizing of revenue, if you have enough products that you create tranches like you did in 2008, and you have the lowest likely homes to be paying rent, and then the ones who are always paying rent in the better areas, you can structure it the same way. So I think some people are smelling a little bit of a similar whiff from 2008, both in the price of housing and the potential for what comes next with that revenue. So that's definitely something we're going to have to watch, as well as just housing prices overall. So I think that's definitely something that we'll be looking into for and the home prices are expected to climb about 12% this year. That's on top of 11% last year and 6% in the next year. So definitely expected to prices will go up, period. I don't know exactly what percent, but I definitely think you will see a price appreciation. And I don't know if that is the time to buy a house, because prices are so high and the valuation is due to dwindling supply and investors pumping into the market. Is that value actually there for that building? Is that asset actually worth that much money? Buy
It's
high and then wind
definitely a
up buying your
seller's
house worth
market.
less.
Definitely a seller's market. And that's the thing, even around here in Ohio, a lot of people have to, in order to get the house, they have to do asking above what it is priced at, and above asking, and then that's when they're able to actually get the house. And these houses could flip within 24 hours.
Yeah. So the market's hot. People want to make their profits, and once you start looking at homes as just another financial asset, you can trade them and inflate their prices, and they can suffer the same market forces as other assets. But the problem is, this is where people live. These are homes. These aren't sandwiches. These aren't stocks, right? So it creates more of a damaging effect, because the investments and the people that use these things, that it might be a bigger impact because people use them. They're bigger investments for human beings, as opposed to just having a stock portfolio. It's definitely something to watch. Definitely some big news today. I found that very interesting. Definitely something we have to keep our eyes on, and you should keep your eyes on just in general as an investor.
Yeah, I mean, I know I've talked to people where they've said that even though like their house has maybe even doubled in value just over the last few years, they wouldn't sell, only because the outcome of getting a new home, the difficulty has become so great that it's just that catch-22. It's like, yeah, you could cash out with a lot of money, but then you're homeless.
Right, and if you can't find a market where the houses are affordable, the prices keep going up and they outpace your ability to buy, then you're stuck saying, well, we can't get our dream home, but now we need to find a home, and we might be buying something that's not worth it. We can actually, that was used to be in our budget, that we was below what we wanted to buy, right, in terms of value and size, but now it's worth this much. So I sold the money that you have, right? And that's the market forces at play. Which, when it comes to housing, if you think about it, if you think more and more homes are bought up for the purpose of being owned by a firm to rent, how do you buy those homes from those firms, or is it going to become a phenomenon where you just see more and more, young millennials and newer generations that are just stepping into a world of rent? So instead of actually being able to physically buy homes and own them, they have to rent them. So that could be interesting as well. I wonder how that's going to go, because I want to own a home. I want to own property. I want lots of yard space. I want my neighbors far fucking away from me. You know what I mean? I don't want to just be, hey, welcome to rent a home, and this is this beautiful house, but you're going to rent it and pay me money each month, but you're never going to pay it off. You're never going to own it. You're going to rent it for decades, but you're never going to own it. But I'm not sure if that's, I don't know how it all works. So we'd have to obviously look into that. Maybe they'll have a way of saying if you live there long enough and rent long enough, you can buy the home from them. Interesting, nonetheless.
A rent to buy. I mean, they already have that in cars. I'm pretty sure they're gonna have that in homes soon enough, but that's gonna be like people locked in. It's gonna be a higher interest rate, and it's gonna be like milking them.
Well, that happens. Well, because that's the other thing too. We have the lowest mortgage rates pretty much ever. We're not seeing as much refinancing activity anymore because low rates don't seem to matter. So if people buying houses and want to get these prices very high values at these low interest rates, if interest rates go up and the house value falls, housing value decreases, the size of their assets and collateral decreases, when they'll also have to start paying more. So interesting. It's interesting development. Whenever you hear about housings and bubbles, your first thought is 2008. So I don't think we're there yet. But again, just like as everything is inflating, we're in a very weird spot where everything is so expensive. Everything is going up in value. So we really have to be careful here about what you buy, when you buy it, and how much you spend on it. So
sounds good. All right, I think that covers it. Any final
that
thoughts?
Covers
Any
our
final
5 main
words?
topics.
Jeremy, Wyatt,
Everything's good.
No, I think that's it. Those are our topics for today. That's our random rabbit segment of the day.
That's that's podcast number 2. Today's June 10th, 2021. As a reminder, none of this is financial advice. You do take all information and use it to the best of your own ability.
You should never, ever, ever, ever take your information from one source and use that to invest in anything ever. Do your due diligence, because if not, and you lose, you can only blame yourself.
But subscribe, follow.
Yeah, subscribe and follow. We want to be part of your worldview. We want to be a piece of it, but we want you to know right off the bat, we're not the answer. We're not going to tell you how to make lots and lots of money, but we want to be part of what gets you thinking about ideas and helps you understand different parts of the market. So, and we're going to have lots of other segments where we talk about specific market things that are in the daily news. So we hope to be a part of your arsenal, but you're the main weapon. Make sure you understand everything you invest in.
We hope to hit the topics that maybe you wouldn't catch on a daily, and these are the ones that could have been the gems of the day that, who knows, can help you make that next 10x, 100x.
We have to come up with a nice, clean way to say that. So at the end of every video, we can say like a 1 or 2 liner that encompasses everything we're saying. Like don't take everything, do your due diligence, and believe in yourself, and we want to be a part of your, or something like that. You know what I mean? Some kind of thing we can end with.
Okay, well, disclaimer. We'll put you in charge of that one.
I'll think of one. I will. It'll be fun. I'll think of one. I will write down notes.
Disclaimer / motivational speaker. I got it.
Yes.
So hit the subscribe button. I'm just kidding. Yeah. I don't even know where I might put it. It could be there. It could be up here.
Well, I mean, if you're on YouTube, the subscribe button is... Oh, yeah, we don't have one on the screen, I guess, yet, but you can click the one underneath the video, because that one is generally always in the same spot. We're going to have a fancy one that shows up on screen, like we're...
So, in time, we're also going to be doing giveaways, lotteries, competitions. We also want it so that if you guys want to argue with Wyatt or Jeremy, you guys pay us, and... we turn off their mic and you guys just go at them, and we'll put a certain time and money value to these things. But I think that could be something fun, and we're just gonna leave the cameras on, and most likely see some faces explode off of Wyatt or Jeremy, or just wanting to respond.
I think in time we'll open up to argue debates, if anyone ask questions or just argue points of view, because on Random Rabbit, we respect every single point of view. Every single point of view is valid. You should always want the full picture. Always find the objective information and understand everything from all sides. So, in the future, we would love to do that once we get a few more viewers on here and some people who want to actually talk to us all about it.
And any additional information is going to be in the description. We try adding any type of resource links down there just so that you guys know, we aren't just pulling these out of thin air or out of rabbit holes that don't exist. So this is our
Nice.
second segment. I thought it was a good time. I definitely learned a lot. Looking forward to tomorrow, guys. What do you guys think is going to happen in the stocks tomorrow? Huh? GME goes down. What? Should we touch on that for like 5 minutes?
I mean, do we want to touch on GME?
I mean, we have 5 minutes before we hit the hour.
That's a big, lofty subject.
lot
Well,
of
let's just talk about how today the stock went down 27.16%.
Okay.
It went down
That is
27.16% from yesterday when it closed at around 302.56. So 302.56 and opening at, let's see, where is it? 282. So that's a big jump. We call that a Poisson process in our financial engineering, and it's a jump diffusion process. And what we just saw here was, well, it could be attributed to multiple things, such as at the end of the day, we saw that every ETF that GameStop was in got shorted. So at the end of the day, all of those were red. You could see the Russell 2000, one of them especially, was around 90% shorted. And it just dropped by the end of the day. It tanked. And that's saying that it was on its earnings beat by 46%. And how high did it beat revenue? 25%?
It was a 25% increase in revenue, but it's still at a loss. So it was a lower loss than it was a higher loss than expected. So they beat expectations. There's still a little loss, but the revenue did increase, and the loss was less than analysts had expected. So that is positive news from an earnings standpoint. But they didn't take questions during the earnings call, and they didn't offer any strategy points for the restructuring, which under normal conditions I think would kind of put a little bit of a damper on most investors looking for valuation, looking for that information. But that was really good. You can always listen to the earnings calls. Every company makes them public. So if you want to hear it, you're welcome to listen to it and hear everything they said. And
you know what I find interesting, Wyatt, is that on their 8K they actually showed that they're voting 96% of float voted. So that's saying that 96% of all shares that are able to be traded had a vote in this. Now, the SEC won't even allow them to put down a number that's excess of float, because there is a company that is in charge of this in order to make sure that they normalize that number so that it's not shown that more votes were put in. But isn't it pretty unprecedented to say that 96% showed up to vote, and yet the stock fell today 30%? So everyone held after April 15th just to vote, and then the next day to sell off?
Well, it depends on how you look at this. If you look at GameStop as a technical trade and not as a valuation that's justified, you could still vote and then sell out to take profits and then buy back in. So there's really nothing against that. I mean, yes, I would agree that you wouldn't think that somebody who voted would sell their position, but then again, GameStop was $4 7 months ago. So I find that we're living in very strange times when it comes to stuff. So perhaps they did vote because they wanted to take part in the restructuring, because they think that how they voted will help the company make decisions going forward, because they believe the stock price should be higher. They believe this rally can be sustained, but at the same time, they want to take profits in the short term, because if you take profits at like 320, 330, and then the stock price drops to 215, 220, well, you can always buy back in, so still maintain a long position, but now you can even buy more of the float. You can get a bigger position. And if you believe with the current, analysis shows about, 9 trading cycle between, the explosion of the short squeezes or the explosions of inflation and price when it goes up to when that kind of rally comes back down, you can kind of time and see like a 9 to 12 to 14 day trading pattern of ups and downs and ups and downs. But at the same time, maybe these individuals had a feeling, wanted to vote for the long term, but then wanted to make profits in the short term and then buy back in. I mean, I've never heard of a company with 96% float voting, but right now it's a very emotionally charged climate. So maybe all the people that did own the stock really wanted to vote. And they really want to help GameStop out. I don't know. I also don't know what the voting affects though. otherwise
What
for the
is
trade.
like an average like float percentage that most companies have? Like how absurd is this?
They say they're surprised when 30% vote of all the shares
Most
that they
people
have.
don't vote. Yeah, especially big
No,
institutions. They put them as
that,
part of funds. They're not voting on them.
and that's a huge surprise. So for them to be like 96%, and usually it takes around 4 days for the company's 8K to come out after voting, but they just put it out there that day, right when it occurred.
Well, when you look at AMC, the CEO doesn't. The CEO dances a fine line for the SEC, where he doesn't talk about this stock price is fairly valued because he doesn't want to be in violation and lie to people, but he doesn't want to shy away from investors and giving them what they want and giving them motivation because they sold 20 million shares over the last couple of months and then made $800 million in capital, which is helping to save their business. He's not going to turn away from it. His stock compensation package is now worth $200 million. It used to be worth $8 million, just because how the inflation of the share price. So, but for GME, I think it's the same thing. I think that's why they didn't give it strategies, because they don't want to tell them that this is going to be difficult and tough to change your business model, but you don't want to shy away from your investors. You want to show them that you're thanking them, right? You want to show them like we're on it. So maybe you'll see, and plus, not to mention, right? Usually you wait a couple of days, but GameStop's going to restructure. You have all these new executives coming in who are from bigger companies who do things more efficiently. So maybe you're just seeing a general, more efficient way of filing where people are like, all right, we're going to get on this. We're going to come out right away.
Now,
So,
I want to touch upon something really quick, and I don't want to say that it's correlated with GME definitively, but I am pretty just confident, not even confident. It's just like, hey, this is kind of correlated just in today's day and age of what's happening in the market. The reverse repo today hit a new record high at $534 billion. Now, for everyone who doesn't know what a reverse repo is, it's the federal government giving institutions who opt into it. They say, the institution says, hey, we need money. And the federal government gives them money, at this point, $534 billion. And that institution gives them securities and assets as collateral. Now, why do you think that is happening?
well, so repos and reverse repos, they're the same thing because they're both sides of the trade, right? One does a repo, the other one's doing the reverse repo. It's the names of the two sides of the repo transaction. And repos are repossessions, right? These
Repurchases.
transactions, repurchase agreement, right? The repossession, repurchase, right? The what therefore is there a way for the government to be able to pump money into the economy to help certain businesses and institutions by saying, hey, you give us a bunch of collateral, we'll give you liquidity, we'll give you cash that you can use, and the agreement is that generally in a short term, because banks do these repo loans literally every couple of minutes, they do them overnight, like they're meant to help do bridge and short-term financing for underwriting and moving capital. But they generally say, okay, you give us your collateral and we'll give you cash. And the agreement is you'll buy it back in a short amount of time and you'll pay more money for your collateral than it was before. So we'll get interest, small amount of interest on the loan, and you'll get the capital that you need to do whatever it is that you need to do. But there are requirements for these things. They don't just give it to anyone, and the collateral that's allowed is actually like mortgage, it's like specifically mortgage-backed securities, treasuries, and something else. So that you can't just use stocks and bonds. Like you have to only use a very specific select group of assets that are, because the government doesn't want to lose money because it's not using its own money, it's using our money. So it can't just, give us, you have like 50 cars in your lot, we'll take that as collateral. Here's a bunch of money. You know what I mean? You can't just take a bunch of stocks and do that because they're very volatile. So, and these are deals or transactions, which means that there are people that are writing these things and trying to underwrite them in a way that makes sense. So they're not just going to keep giving money, especially if they give money to somebody and then they lose money. They're not just going to keep giving them more repo loans. But I think the repo loans have been increasing over the last couple of months, and I think that coincides with the Fed's quantitative easing. Their easy money policies, just pumping out money into the economy, keeping the interest rates low, which is an argument that everyone says, well, the interest rate's going up. I mean, inflation's going up. So, should we kind of tune this down a little bit? Should we stop making it so easy and putting so much money out? And most of the institutions that get this are not just everyday institutions. They businesses that need cash flow, big institutions that are going to instill cash flow into the market. So there are a lot of requirements. I don't know them all, and I can't tell you a list of the companies that are getting it. I don't know if there is a list out there that you can see that shows the specific companies that are getting how much specific money, because that would be very, very helpful. That would give you the transparency you need to identify where money's going. And then, if you want to say there's a correlation between that and how the shorts on different companies, if you could find that connection, that would definitely be some powerful information. But I don't know if it gives money to broker dealers.
Allow me to tell you my theory. So putting in perspective for the reverse repo rate at this moment, on March 31st, the reverse repo hit a high of $284 billion. The next couple of days by April 7th, it's at 88 billion, and it keeps going down until like May 6th, in which it's 1.17 billion, and it keeps going down, and it stays steady down there. It doesn't even hit $1 billion within the time span from July 13th, 2020, all the way until February 26th, when it finally spiked up to 11 billion in reverse repo, and then it started going up. It started hiking and hiking and hiking more and more. Now, this is my theory, and I haven't conclusively found out which institutions are participating in these reverse repos. But my theory is the only reason that corporations ever do reverse, or institutions ever participate in reverse repos, is due to cash flow problems. So at this moment, with its reverse repo at $534 billion, I believe that they're using this cash overnight in order to meet their margin calls, and in order to say, hey, we're just going to borrow money from the government, meet our margin calls, and then the next day we return it. But of course, they're buying back their securities at a higher price, and that's the game that they're playing. They have to pay more money in order for them to keep their positions open on the shorts side.
Okay, I have a question though. If you take that capital, so let's assume that broker dealers like Citadel and all these other guys, let's assume that they're getting these repos, they're getting the money, they're giving some acceptable, valid collateral of some kind to the government, saying I'm going to buy them back later. I need short-term coverage to fill my margins. When you fill the margin, the capital you just borrowed, you lock it up, right? So how do they generate the capital needed to buy back their assets and then continue to do this? Because if you put your money in the margin account, you don't just put it there temporarily and then take it out. The other broker dealers are like, hey, listen, this is your position. This is your margin requirement. You need to keep meeting it and then possibly increasing it if your position is moving against you. So where would the capital come from to buy back the collateral from the government and then continue to do this? Because it seems like there would be a cash, like if they have a cash flow shortage, so they get cash for collateral, they park their cash in the margin. Even if they can take some of that back out, they need to take out more than they borrowed, right? More than they got to their collateral back as part of the repo agreement. How does that happen? Even once, if not continually, how do you sustain that? Because it seems like that'd be like deficit spending, which governments can do, but because they can print money. Companies can't, because they need to make more money. So where does that extra capital come from? How do they maintain that?
So all they have to worry about is their interest on excess reserves plus 5 basis points. That's what they have to pay back when they're getting this repo loan, right?
How do they pay it back if the capital they used is locked
it's
up?
just overnight. It's just switch overnight.
Right, but what I mean is, when they put their money into the margin, do they take the money back out of the margin overnight and return it to the government? Because then you're still going to get margin called immediately.
I mean, all they have to do is show it for one moment that they met their margin. That's all they have to do. They just have to say, hey, at what time are we margin called? We're showing that we have it on cash on balance. And then they're able to say, okay, great. Now we can return it the next day.
As soon as you take it away, the middleman's going to say, well, now you don't have enough money. The problem with that is it's not like only once a day do you have to prove it. It's continual, because those securities are continually being priced. And the broker that's holding your short contract, they don't want to get caught out in the rain. They don't want to have to make the difference up, because that's a risk to them. So they're going to make sure your margins are always filled. When you get margin calls, it's not like margin call to prove to me that you could get the money. It's margin call, keep the money there. I literally want you to put your money in this account so I can see it. And then if that price moves against you, you're going to put more in. And as soon as your account misses that level and you don't fill it, we are going to sell your shares because we don't want to have to make up the difference in returning the shares that you borrowed to short.
You want to know the most messed up thing is that those are the rules for us, not the rules for the institutions. Institutions, when they get margin called, they don't have to shore up their account right then and there. They can wait 2 days. They could wait up to 5 days to shore up their account for their margin calls. And in that time, they could get reverse repos and just, hey, we got the money. And then they could even do longer reverse repos instead of just overnight.
But my point is that, my point's from the margin call side. When you get a margin call, it's not like show me the money. It's park your money in this account, and you can only take money out of your margin if the position moves favorably towards you. So you don't need to have as much insurance in the bank. That may be true. I'm not sure, but that's true for institutions. I would love to see if that is true. But even if they can wait 2 to 5 days, and maybe that's because their margins are much bigger, so they realize there's a more capital to move. When you still put the money in the margin, it's not just a temporary one-time thing, because that's like saying, okay, I'm margin calling you, so you need to put more money in the margin account to cover your short position. But so I'm worried about the risk right now. Well, if you put your money and then take it back out, why would I stop worrying about the risk when you take it back out? Your margin still doesn't have enough money to meet the amount that's needed. So to leave it in there and say, okay, this is good. Now I understand that if they did a larger one, perhaps if the position moved in your favor, you could then take the money back out and give it back to the government. But then I have to ask, I'm not 100% sure when the REITs are given to businesses for cash flow shortages. That's a very liberal, interpretation of it, because what do they mean by business and what do they mean by cash flow shortage? I don't know if that means just
business
anyone,
or investors. And that's what it says. And the interesting thing about these reverse repos, which you can find on fred.stlouisfred.org, and it shows you the whole economic research on the reverse repo rate at this time, you'll see a pattern. It usually spikes up and then it goes back down for the next days. This has happened in the past weeks where it's just been continuous and it's been hiking up and hiking up and hiking up, and it doesn't seem to go down. Well, we'll see tomorrow if it goes down, since today's June 10th, and tomorrow should be interesting to see if the reverse repo actually does go down, or does it keep hiking up.
But think of how much money is being spent. That repo goes up. So you're saying that, like, how many companies are taking repos? In your mind, how many companies are taking repos to support huge short positions and covering them?
Well, we have it right here on apps.newyorkfed.org. We're able to see that the fixed rate same day reverse repo has 54 participants. 54 participants. Who are 54 those institutions. And I've been trying to find who these institutions are, but they're making it really difficult.
And you think some of those institutions are broker dealers trading in GameStop?
That would be the interesting thing to find out. If one of those broker dealers, one of these 54 institutions, happens to be Citadel or one of its branches of Citadel.
Well,
and you want to know what's also interesting?
Yeah. What is it?
Let me tell you. The next interesting thing is how much the U.S. Treasury is actually able to give out an aggregate operation limit. Their aggregate operation limit is supposed to be $500 billion. They're not even following their own rules. And that was effective as of February 12th, 2021. And they say their proposition limit is 2 propositions per eligible collateral type, subject to a $20 billion maximum per proposition. So that's just saying that per institution, they could only ask up to $20 billion.
Right. So have you measured the size of some of these required margin calls for these institutions to see if that even fits in with $20 billion requirement?
And that's going to be the next research we're going to start doing in order to dig deeper into this topic, because we can go into the rabbit hole in this whole meme stock, GME, AMC, all this stuff. We could dig into it, and we will find out that there might be just a lot of fraud going on.
Okay.
I
I think that wraps it up for today's segment.
yeah, I agree. I
You know,
agree.
before you guys keep digging and digging and forget that you guys aren't using shovels and you guys are actually using hands. Um,
I'm digging. I'm digging.
yeah, no, that was a good segment. We're finishing off podcast number 2. Go ahead and subscribe, follow,
Yes.
tell your friends, tell your family. Any
Your
topics that
pets,
you,
your goldfish. Tell everybody.
we're pet friendly, so like set your pup right in front of it, and he'll just take it all in, and who knows, he'll probably make you more money than you. Hey, monkey and balloons.
I like it.
So yeah, let's go ahead and sign off. Appreciate your guys' time, and
Yes. Thank you, everybody. We'll see you tomorrow.
we definitely hope to catch you guys on the next live stream. Check out our YouTube videos if you missed anything. We follow up on all the topics, and at the end of the week, on the weekends, is when we're going to have our live podcast. There's going to be no holding back, and so it could go on for 1 hour, it could go on for 6 hours, just talking about, you know, GameStop or any other meme stocks that are manipulating the market currently. I'll just leave it at that. But with that, we'll go ahead and sign off. You guys have a good night.
Good night, everybody.